the end is near. Jerome Powell announced it just mere hours ago. The Fed might only raise one more time this year in 2023 and gave a bit of an outlook of what they're planning and expecting from the economy, from the markets in general as well. And I think found a fantastic guest to discuss what is happening in the markets right now, in particular in the gold space. We are a gold focused, commodity focused channel. So I'm really curious to hear the explanations of Mr. Axel Merk over at Merk Investments about what is happening in the market. Axel, it's phenomenal to have you on the program. I'm sure it's a busy, busy day for you, so appreciate you taking the time.
Oh, it's my pleasure to be here. We were debating whether we should have this call before or after the Fed meeting. Everybody's always so glued on what's happening with Powell. But of course, the disadvantage of doing this right afterwards is, since the market doesn't always continue to react the way it immediately reacts, is that now we are supposed to know what has happened. Whereas before we had at least the luxury of saying, oh, we don't know yet. Yeah.
We had 30 days to come up with a theory, right? And now it's 2 hours after the meeting, and we need to make up new theories pretty much in a whim, and what is happening. Axel, do you want to summarize for us what just happened 2 hours ago? What did the Fed do, and what are your first reactions?
Well, the Fed raised 25 basis points, and then we had a press conference. And why are we having press conferences when we know what's going to happen? Powell, on several occasions, has put the foot in his mouth and said things that he probably didn't want to say. But they have this duty, they think, that every time they have to say something. And obviously, the broader context is we have a little banking crisis going on that is, quote unquote, tightening financial conditions. We have a little bit of inflation going on, and so everybody's a little bit confused. And don't think for a moment that the Fed isn't as confused as all of your listeners are. And so in that sort of environment, of course, he needs to find a path forward. If you look at the FOMC statement, it says kind of one of the first sentences says financial system is sound. Well, what the heck does that have to do in that statement? So they say what they gotta say, and to just put that into, let me give you an alternative reality, that the market would focus on inflation and unemployment. That's kind of what the Federal Reserve is supposed to do. Instead, we are zooming in on what Powell is going to say, what he might not say. And that's just a symptom of what's wrong with the sort of monetary policy that we have. But to answer your question, yes, we got 25 basis point rate hike. And the Fed said, well, maybe we'll hike more, maybe not. And yes, we discussed a pause, but I'm not supposed to say that we might have thought about a cut, because if I said that, the market would react differently. So I'm not going to say it.
Like, it's very sensationalized. I've noticed myself. First thing I did, I went to Twitter to see what was being tweeted about the rate hikes and the Fed action. So it seems like we're always looking for something. It's just that one little word maybe in the statement that could change market momentum completely, right? A lot has happened over the last 10 days as well. And the banking crisis you mentioned, and the stability in the sector. And how much did that weigh on the decision by the Fed right now to hike or not to hike? And they did hike, obviously. But how much did they weigh on the decision? And should it actually weigh in based on your commentary?
Yes, but it's not quite as simple as that. First of all, as I was trying to allude to, if the Fed had a rules-based strategy, they took inflation into account and unemployment into account, we wouldn't be where we are today. Instead, we have this higher for longer thing where, almost by definition, because it's comedy driven, they're going to be late. They're late in hiking rates. They're going to be late in stopping to hike rates. And by the way, there's no assurance that when they pause, that inflation will be beaten, because once inflation is high, it's no longer linear. And so that's the broader context. And of course, the policy we've had encouraged the banks to pile on long duration securities on the balance sheet. There was a lot of deposits. They were taken out, and Silicon Valley Bank blew up. And a bank blowing up, and we can talk about that more broadly, but one way to look at it from the Fed's point of view, that is a tightening of financial conditions. And by the way, the whole point of raising rates is to tighten financial conditions. I take it a step further. The whole point of hiking rates is to break things. Now, obviously, the Federal Reserve would like to break the small stuff, not the big stuff. And so when the big stuff breaks, then it might get out of their control. But if you look at any small bank, even if they have FDIC insurance, even if they expand that to be unlimited, there is going to be more scrutiny on this big mess up of managing the duration risk on their balance sheet. And so they will have to be tighter in the sort of lending that they have. And obviously, there's political backlash and so forth. All of that is not going to be good as far as kind of providing loans. And so, yes, there is a real impact on the Fed's trajectory because the market is doing some tightening for them. Now, of course, at the other end of the spectrum, as you probably aware, mortgage rates have come down because the market says with all this mess, long-term growth prospects are coming down. And by the way, bailouts can create zombie banks. That is not good for long-term growth. And so on the longer end of the spectrum, it's negative for growth as well. And so, and also, of course, the market with the inverted yield curve is screaming that we're nearing a recession. So yes, by all means, it does have an impact on monetary policy.
Well, absolutely. The recession is near. Like we've heard that in numerous conversations over the last few days. When do you expect the recession to kick in? What kind of indicator are you looking for? Is it inverted GDP, like negative GDP? What's the main indicator there? And by the way, you mentioned a lot of things that I'm going to follow up on in a minute here as well. That in your last answer. So
Yes. So let me then not answer your question, but a related question. Why are you asking about a recession? The reason why we're interested in a recession as investors, as we're talking, is severalfold. Historically, risk assets, equities, don't do well in severe recessions. Like recession, it could be looking through, or if you take since we're gold people here, in a light recession, people don't care so much about gold. In a more severe recession, if history is any guide, gold tends to be doing quite well because gold investors are forward looking, and as earnings kind of go down the drain and equities might be suffering, the easing of policy that's expected tends to be favorable for gold. So for a gold investor, it is important to think about when recessions might come, especially if they're more into market timing and whatnot. And so yes, recession indicators were flashing yellow. Now they're flashing red in the sense that the yield curve is very severely inverted right now. That's one of the many indicators one can look at, which tends to precede a recession, right? And usually what happens is, of course, the Fed is tightening for whatever reason. Then they break stuff, and then they have to reverse course. And the recession then can happen several months into that. With the additional tightening that we now get with the banks being all afraid, that might be accelerated. Now, the only caveat is some people have pointed out that big banks are not inhibited, and so this is all going to be more gradual. Yeah, maybe. But as an investor, I'm focused on risk-based scenarios. I don't have a crystal ball. I can just take risks into account.
Absolutely. The banking crisis, just one thing I want to follow up on. Like, how has it been missed? You mentioned, Powell wanted to break stuff. He said it himself. We'll have to raise rates until something breaks. I personally always thought it'd be the employment or the unemployment market, like the jobless claims, would spike at some point. That hasn't happened. One question I have, I had a lot of experts here on Soar Financially as well, and none of them talked about unhedged banks or anything, right? Like, it's always that black swan. Was that the black swan event that broke, or the straw that broke the camel's back, the black swan that landed on a camel?
Well, it's a straw, right? We don't know whether it's the last one because we're obviously not done with the tightening cycle. But yes, the idea is that the higher for longer principle was that you're going to tighten, and that will slow down the economy, and that will get the economy back into balance, always knowing that the so-called unknown is going to whack you. Whacking is kind of a CFA term that not everybody might be aware of. But if you look at any environment, not just in the current environment, if you look at rate hikes that are being priced in, if you look further out into the market, what's priced in, there's always, people are wondering, why are rate cuts being priced in? Well, there are always rate cuts being priced in because as an investor, the risk of this unknown hitting you is increasing as you move out in time. And so, yes, we have a tighter environment. Bigger things start breaking. If anything, I think there's a surprise that not more big stuff was breaking last year. You recall the blow up in gilts in the UK, that there was no spillover effect to the US. And so this is happening now. But at the same time, I just mentioned, right? Banks are going to be tighter. We just had another 25 basis point rate hike. There's another rate hike priced in May. We continue to tighten in this environment. And so that's why I'm saying this is a straw that's breaking the camel's back. There might be more straws. We don't know.
Yeah, it's like I wrote down a quote on my notes here, and it's some additional policy firming may be appropriate, right? So the Fed is actually leaving the door wide open in case inflation doesn't come down, because I personally don't see it coming down much further than below 4% personally, based on all the macro factors I'm seeing, onshoring, like build back better and all those things. What does that mean? Like, keeping or some additional policy firming
What
may be
it means,
like the Fed has some targets,
means,
right? So,
well, yes, three targets. Most people think about employment and inflation.
yes.
But the third target is really the overarching one, which is financial stability. So yes, if tomorrow Madame Yellen has a magic wand and calms down the banking system, then and employment numbers continue to be strong, then the Fed will continue to tighten. Except I don't believe in magic wands. And so that baseline scenario I don't think is going to play out. Of course, it is possible that things are going to get calm, but as I just mentioned, the Fed continues to tighten. That means the risk of more stuff breaking is very high. And by the way, there is fallout. And the reason why there's so much fallout, let's take a step back about what's wrong in the banking system here. It's the same thing that's wrong in every banking crisis. There is not enough capital, right? Banks should have had a margin call, but accounting rules dictate that you carry these bonds at cost because the bureaucrats decided that they're safe. Well, the market decided it's not safe to have a big hole in your balance sheet, and people took notice and run with the money. And so now some banks are in the news, and they say, we should be raising more capital, but we don't like the environment we're in, so we're going to wait. And then please, FDIC, give us more insurance. And please, Fed, give us some liquidity. That's called patching up. That's called putting a Band-Aid on things. And if 2008 is any guide, Band-Aids are usually not very good. Now, of course, we could theoretically guarantee all the deposits, but what that means is if banks really take advantage of that facility of the at the Fed, and some of them obviously do, they're going to pay through the nose in interest expense. At the same time, the depositors are fleeing, which means those banks are impaired. They may not go bankrupt. Depositors may not be losing any money, but economic growth is going to suffer. And so all this stuff has consequences. Usually, if you get a margin call, right, it sucks because you have to sell at the low. Well, it sucks for banks to get a margin call, but the right solution is to raise capital. And yes, that will wipe out the equity holders, maybe not entirely, but dramatically so. And that's why they're so reluctant to do it. So the emphasis of regulators should be to force these banks to raise money, no matter what the cost is. But instead, they're all gang-ho about guaranteeing everything. And so we live happily ever after.
Yeah. Like one thing we've said after 2008 is we should have just let them fail and let the market clean itself up and then pretty much hit the reset button, right?
Well,
That's
you said that, maybe I said that.
Darwinism is, right?
Yeah, you said that, I said that, but maybe certainly not Mr. Bernanke and co, right? And so it's and that's one of the challenges in the gold community when you talk to folks that like gold, right? We tend to have that mindset, but that's elusive, right? Bailouts rule. People get bailed out. And one of the bad things about it, aside from there's several bad things about it. One is you're taking away yet another market measure of the health in the financial system. So you're relying on the bureaucrats, which means everybody is happy because the bureaucrats tell us everything is safe. But then when things break big time. And so you just can't run a system in the long run with that. You also have a disillusioned public, right? I mean, the reason we've had a rise in populism and elect more extreme politicians is because people realize something is wrong. And I would bet we wouldn't have had Trump elected in the U.S. if we didn't have these bailouts in 2008. Those are all consequences, and you can't tie them directly. But when you veer away from capitalist principles, you're inviting backlash.
Absolutely, we're witnessing that left, right, and center every single day. Looking at the gold price now, reacting to what the Fed just did, and I'm a bit surprised actually that gold is up almost 1.7% as we're speaking. Are we in a bull trap, Axel? Or is this another a rally? Where do you see things headed? I'm personally, for whatever reason, maybe I've been beaten over the head too many times, Axel. Quite negative because I was in the bullish camp starting mid-November. I invested in companies, I purchased in private placements, I bought on the market, only to have been hit over the head again come mid-February. My point is, we tried to fight the Fed. The Fed won, and now does the game repeat? Do we get a rematch?
Well, we we manage about $1 billion in gold and gold mining, and I'll answer the question the way I see our investors react to the price of gold. I basically see three types of investors in gold. Gold mining is a little bit different, but in gold, one is the investor that's worried about the purchasing power of the dollar, and I'll get to that here in a second. The second one is the gold investor that likes gold because of its diversification characteristics. And the third one is the speculator. They just love a good run and they pile in on it. The speculator kind of moved more to the meme stocks, digital currencies, because there's much more action. Obviously, volatility has picked up recently, and so maybe we see some of that coming in. On the diversification side, last year, diversification was really bad with just about everything. I actually think diversification in many asset classes is better this year. And so you have more investors in the gold space coming in because of the diversification characteristics. And then you have the investor worried about the purchasing power of the dollar. And people are saying, oh, we had high inflation. Why didn't gold go up? And why is it going up today on this and that? Well, when we look at the price of gold, and gold isn't really correlated too much to anything, but the one area it's more correlated to is longer-term real interest rates. Now, that might be a mouthful. And notably, if you paid attention, what that is, it's the TIPS yield, the yield of inflation-protected securities. What is priced into the market, what real interest rates will be in the medium to longer term. Now, many gold listeners will say, well, what the heck? Nobody knows what real interest rates will be 5, 7, 10 years down the road. But you do have market measures of what the market thinks it will be. And 100% agreed, we don't know what real rates will be, but we know, and that's what these are. These are measures of the confidence in the market on the ability of the Federal Reserve to control inflation of the medium to long term. Market-based measures, not your measure, my measure, but the market-based measure. And on a day like we're speaking today, after Powell was all said and done, the real yields came down. And the reason why gold is competing with real yields is because, well, gold is a brick. It doesn't pay any interest. And so if you get rewarded for holding cash in the long run, not today on the short-term CPI, but in the long run, then you hold cash if it rewards you, or gold if it doesn't reward you. And so when the real yield comes down, those longer-term measures, gold historically tends to move higher. Obviously not a perfect correlation, but if you're asking me why the price of gold goes up today, and I have to give you an answer, that's the answer I would give you.
I love the answer. It's very clear, very concise. My question now is, where are the speculators, right? Why are they not in gold? Or it doesn't feel like they're in our sector at the time. Where are they right now?
Well, they've been all over the place. I mean, they were in the they were in the meme stocks. They were in a whole bunch of places, right? Speculating in options, all kinds of stuff. But keep in mind that part of the point of raising rates and tightening financial conditions is to ensure that money isn't free anymore, and that takes down the speculation as well. The reason we have so much volatility right now in the markets more broadly is in part because of all the bailouts we're getting. Is because when governments interfere in what's supposed to be happening by changing the rules along the way, financial markets react. And so we get a lot of volatility. Now, that sort of government-induced volatility does reduce leverage. because if you're highly levered, it's very, very costly. I mean, if ever since 2008, if you did the rational thing, you probably lost money, unless the rational thing is to bet on bailouts, right? But if you were to, you talked about market forces, if you were to allow market forces to play out, and so that's part of the reason you don't have as many speculators. But yes, I mean, we did have obviously a very significant move in price of gold of last week and this week in the other direction. So.
Yeah, absolutely. Axel, you run a fund, so I have the advantage of asking a fund manager how it's looking on the ground, pretty much. Like, are you seeing inflows or outflows right now? Because that always dictates sort of the mood a little bit as well. Like, how's it looking? If you can answer that question.
Well, we mentioned a few things. On the physical gold side, we had some significant inflows early this year against the trend in the industry that had outflows. That was a bit unusual. We tend to move with the industry, gaining a tad of market share because we think our product is better. Of late, it's been fairly quiet, volume very high. On the gold mining side, we actually have a closed-end fund that was launched in 1958. Last time it raised money was in 1958. Haven't had any inflows, outflows since then. We are managing it since 2019. And so we are shielded from those flows. It allows us to do things that you can't do with what in the US we refer to as an open-end product because we don't have outflows and inflows. But there, to just talk about that just for a second, the people often think, oh, the junior miners are levered play on the price of gold more so than the majors. The junior miners, though, of course, are notoriously always in the need of capital. And so when financial conditions are tighter, that's a headwind to many of these juniors. You do have the credit risk in that sense when you invest in these very junior exploration plays.
Yeah, optionality is a word I'm not sure I like, and I've been in the sector for 12 years, meaning they have a ton of ounces in the ground, but nothing going for it, right? So that always provides some leverage.
On the upside, right? Especially the explorers, they can throttle down expenditures much more than a producing mine. And so when they see that the money is going to run tighter, they can drill fewer holes, right? And the gold is not going to disappear. Somebody else is going to buy that asset. So that's it's a very unique space.
Yeah. Axel, allow me to question, like, since we're on the topic of miners, a question just came to mind. We haven't seen a lot of M&A activity in this space. You know, Newmont now bid for Newcrest. That was probably the biggest transaction we've seen in a long, long time. Agnico was fairly active. My point is, debt was fairly cheap to come by in recent years. It's gone up now a little bit. Do you think the miners have missed an opportunity, or are they always acting too late? And I know my question is a bit negative, but have the miners missed an opportunity with the cheap debt?
Well, I'm not going to talk specific companies, but
No.
miners tend to do what the market wants them to do. And so in the last bull market, they were spending too much to acquire ounces. And then everybody told them, oh my God, you got to have more discipline. And so they took that to heart or to an extreme and cleaned up their books, and the balance sheets of some of the bigger ones look great. The downside of that is you're reducing the leverage to the price of gold, which is one of the reasons you're these companies in the first place, because they're generating so much cash. Well, you actually want them to have, which is a bit ironic, of course. And the problem with any gold mine is you're depleting the resources that you have in there. And so at some point, they need to acquire things. Now, at the next step, the few acquisitions that have happened, the market hasn't been very kind to. So that's not exactly encouraging them. They still have a few years, then the big ones have to acquire. In the meantime, you have these medium ones trying to figure out, well, if the big guys don't buy us, then we got to maybe do something. And then at the low end, of course, these guys also want to survive. And if they don't have access to financing, you're seeing some mergers in the small ones. The terms are sometimes a little bit odd. But there will be more activity. There has to be more activity because that's how the industry works. You need to, in order to have capital industry, you need to have also a greater critical masses. What we try to do is we try to find targets that might get acquired because they're digging a hole right next to the big guys, and that's kind of what the big guys do, right? They outsource the exploration, so to speak, and then acquire them later. But even on that front, right, very, very little has happened. In my view, it has to happen at some point. And is it too late? Well, I mean, if the market is not favorable for buying things on leverage, right? The stock prices are down in many of these things, so it might be cheaper in that sense. Um, I think it's high time for the merger activity to increase. At the other end of it, you mentioned earlier you're somewhat negative. Unless we've seen a merger frenzy, I don't think we have seen a peak in the cycle.
That's a very good point. Sorry. Actually, my very last question is like, and I want you to break a bit of a tie between a friend of mine and myself. As I mentioned before, I'm more on the bearish side. He's super bullish. He bought some juniors recently. He jumped into the market. What side are you on? Let's say midterm, the next 6 months or the next 3 months. Let's for the juniors in that space.
I am a long-term investor.
Okay.
And so you can look me up in public records. I don't transact much,
Okay.
and have held significant stake in the juniors. I don't intend to trade that stuff anytime soon. Obviously, I'm a little closer to it since I have a good team to manage those investments. But the kind of we are going to enter a reflationary environment. I mean, this is classic recession beginning where we talked about the Fed's pivot. I actually think the quote unquote pivot happened last November when we moved from when we signaled we had moved from 50 to 25 basis point rate hike. Ever since then, the price of gold has behaved favorably, and the reason is exactly why, because of gold is doing what it's historically doing. And as the Federal Reserve is moving towards an easier environment, that will be beneficial for that sector. Now, that said, and the one big curveball in that is, of course, the quote unquote higher for longer, where they will try to not lower rates too quickly. So that's a bit of a unique factor. But at the same time, have a good banking crisis, and it will whip the Fed in shape and induce a more traditional path, so to speak.
Yeah, don't waste a good banking crisis for sure. Fantastic. Axel, phenomenal conversation. We started at the macro, ended on the micro. I really, really appreciate your time. I'm sure you have a very busy day, so I'm going to let you go now. Before I let you go, what's your Twitter handle? I know you're super active on Twitter and, of course, merkinvestments.com, the website, I guess.
The website is good. I have a newsletter. At Axel Merk is my Twitter handle. And yes, when there's a good banking crisis, it's my stress relief to tweet. As you might be aware, because we manage money, we are regulated. And on Twitter, as long as I don't tweet about products, I have more freedom than other places. And so that's really the best real-time place to get information from us. But sign up for a newsletter on our website. Then you can get also more in-depth and longer-term information.
Fantastic. Axel, wonderful conversation. We'll have to do this again very, very soon. Appreciate it. Thank you so much for coming on. And everybody else, thank you so much for tuning in. It was a great conversation. As I said before, we started on the macro, talked about the banking crisis, the Fed rate hike decision, next steps for the Fed as well. And we ended a bit on the micro, talking about mining stocks and what the miners should be doing and are doing right now. We hope you enjoyed this conversation. I know 90% of you watching, for whatever reason, are not subscribed to the channel. There's a button that says subscribe on it. There's that little bird in the corner as well. You can just click on it, hit subscribe. We tremendously appreciate it. That way we have guests like Axel coming back frequently, and we appreciate your time and effort and your comments as always. Thank you so much for tuning in. We'll be back with lots more.